Hi everyone, welcome to Your Money, Your Call. I'm Nina May. Well, Ben and Roger, welcome to the program.
Thanks,
Great to have you on Your Money, Your Call. Good to have you both back. Two of our guns for the show. Roger, what was your read on what happened today? Yeah,
I wrote on my blog, and I mentioned it to you the last time we were here, that my big concern is that there is indeed a property bubble in China. We can see that. It's that currently under construction is 30 billion square feet of residential and commercial real estate, in addition to the real estate that already exists. This is what we're saying is what is under construction today, and that is equivalent to about 23 square feet for every man, woman and child in China. It's more than they're going to need for a very, very long time. And when you look at prices over there, it takes, I think the average salary for a median property in Australia is about 8 years. It's about the same in London. It's about 12 years in New York, and it's 39 years in Beijing, and almost 50 years in Shanghai in some places. So sure, they're very low salaries, and their salaries will pick up, but it still strikes me that there's enormous supply. There's construction going at an incredible rate, at an unsustainable rate, and when that stops, not if, but when that stops, then that has been a very big driver of some of the commodity demand that's been fueling the share prices of RIO and BHP and others.
Yeah, and as you both say, what happens in China does have an enormous impact.
Well, it used to be that when America sneezed, we got a cold. It's now China.
Yeah, we get the flu.
Exactly.
Okay, let's go to our first caller, gentlemen. We've got John from Sydney on the line. Hi there, John. Thanks for joining us.
Hi, Nina. How are you?
I'm very well, thank you.
Yeah, I'd like to say hi to Ben as well. Yeah, I met him in the ISX seminar last week.
There you go. Thanks for that, John. What's your question tonight for the guys?
Regarding CEY, Centennial Coal, I would like to ask whether the current level, around $4, is level to buy, and how is the target for the next 1 or 2 years for Centennial Coal? Thanks.
Okay, well, Ben, CEY is a stock code there, and it's currently sitting at $3.97.
This is the thing with commodities. Prices go up for the commodity. There's a supply response. That supply response generally pushes prices down, and of course we've got the situation in China at the moment, or the potential for a decline in demand from China. Typically, analysts are very, very bad at predicting change. They're very good at predicting a continuation, but when things change, they're usually catching up.
Well, hence the lack of prediction about the GFC that happened.
Exactly, and that's just one example. There's millions of examples like that, and so analysts tend to be very, very bad at knowing when things are going to stop going the way they've been going. And I think, look, I'd eat my shirt if I could find a coal company in Australia that was trading below my intrinsic value. There simply aren't any.
Our next caller is Lee, who's in Perth. Good evening, Lee.
Oh, hi. Hello. How are you?
Hi. Very well. Thanks for calling in.
The one I'm interested in is called Mortgage Choice, the code MOC. It's got a rather high return on equity over the last 4 or 5 years and pays a high dividend yield. I just wondered what the panel thought about that one.
Okay, stock code MOC, and the company is Mortgage Choice. There's the chart sitting at $1.23. Roger. Yeah,
look, my value for this particular company is slightly less than where it's trading at the moment, but I no longer think it's a brilliant business. I don't think it can be an enormous business, and I like to buy businesses that are trading, one, at a discount to their value, and also have the potential to be significant businesses.
Why not?
Well, the reality is the landscape has now changed, and where we once had an environment where people were literally falling over themselves driving their RAV4s to your house to try and lend you money, that's changed. And it's changed because of the global financial crisis, and there's a generation of people now who will probably prefer to borrow from the bank because of the security that has. Banks have been able to reduce their rates, and a lot of the non-bank lenders have not been able to do that because they haven't been able to get the funding to fund their books. And so I think that we're going to see a whole bunch of young people that'll just start telling their kids when they have kids, only ever borrow from a bank. We'll all sound very conservative, but I think that's what's going to happen. So I think there's a very different outlook for this business. Its prospects aren't as bright as they once were. takeover speculation is different to investing.
Yes.
You know, I think it's important to make that distinction. And companies may make a takeover, but gosh, there's a long history in Australia of companies doing silly things with excess cash. So you know, you may make some money if you speculate on a takeover there, but you know, whether or not it's good for the shareholders of the acquirer, I don't know.
And Pat would like to get your view on Virgin Blue, which is stock code BBA.
Okay.
Roger, do you see it as a buy?
How much time have we got, Nina?
Well, look, you've got 50 minutes left on the program, but that doesn't mean you have 50 minutes to talk on Virgin Blue.
Look at that share price. I mean, it's completely ridiculous why anyone would want to own an airline. It absolutely beggars belief. The value of this company is around 50 cents. It listed at $2.30 or $2.40. I think it was back in, when was that, 2003? Was it 2003, I think? Yeah. About 7 years ago. And its value then probably was about the same. You don't want to own businesses that are capital intensive. You don't want to own businesses whose accounts show a profit but economically they actually make a loss. And that's a function of the fact that the depreciation charge doesn't fully cover or doesn't fully estimate or appropriately estimate the cost of actually replacing aircraft. I don't want to get too technical, but depreciation is based on the historical cost of a plane. They have, say, a 20-year useful life, and then you've got to buy a new one. The new one you buy is much more expensive than the one you replace. And so that depreciation charge isn't accurately reflecting how much it's going to cost to replace your fleet. And so you're showing a profit because you've got this cost which is underestimating the true cost of running an airline. And so as a result, airlines don't make any money. In fact, the IATA, which is the International Air Transport Association, came out with a report earlier this year, and they said over the last 10 years, airlines globally have lost $46 billion, and this year they're going to lose $5.8 billion. Now, that doesn't inspire confidence. And so I just prefer to say, if you're not prepared to own the whole business, don't buy a little bit of it. And if you're not prepared to own it for 10 years, don't own it for 10 minutes. Yeah. Well, it's cheaper to fly down to Melbourne than it is to ride a bike.
Or get the taxi.
Maybe that's why there's a 2-week wait for Perth, because you can't actually ride a bike to Perth.
Yeah,
get a taxi to the airport. Great point. Pay for the car parking. Nick from Sydney is our next caller. Hi, Nick.
G'day. I'm calling about a company called Eastern Star Gas. There's been rumours going around for a while now that Santos is looking at taking the company over. I'm just wondering if you guys know anything about that and what you think of the company in general. In the case of Santos,
their scrip, their shares are so overpriced compared to the value of that company that it would be they've got some ability to buy some things with that paper. They're giving away a very cheap piece of paper if they use their current share price, because there's no way that their share price is justified by the performance of the business.
From Sydney, hi Abe.
Hi Nina, thanks for taking my call. My question is about Woodside Petroleum. A lot of brokers have been recommending that stock for a long time, and yet it seems to go sideways with all these projects and Gorgon and all that going on. Why is it going sideways? Why is it not reflecting the share price?
Well, I can't explain the share price. I don't know why share prices do what they do. All I know is that people are buying and selling it all the time. What I can tell you, though, is what the business is actually worth and whether the value of the business is actually going up or down over the next couple of years. Woodside is worth about $26, and look at the share price. You know, it's closer to, what is it, closer to $45 or $46 at the moment, and I've got it valued currently at 26. Having said that, though, over the next 2 years out to 2012, I've got the value rising such that the value in 2012 will be higher, a little bit higher than the price today, but you're waiting 2 years for that. So if you're buying it today, you're not buying it with a margin of safety. And why is this happening? Well, all the analysts' forecasts for China are a hockey stick. You know, there is just blue sky, and all the earnings per share for all these companies are just going in a smooth northeasterly direction forever. And when you look at, even when I take those optimistic numbers and put them in and produce a return on equity for Woodside, I'm getting a return on equity of 12% this year, going up to 20% in 2012. Debt to equity is 40%. That's neither here nor there, but that return on equity is okay and it's improving. Even with those numbers, you know, you're waiting 2 years for the value to catch up to the price today.